Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Neuberger Berman US Equity Premium Fund. This is the first alternative fund that I'm covering, so it will have a different color theme. This video is done as a follow-up request from a viewer's comment in my previous video covering the Allianz Global High Payout Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. Neuberger Berman is a US-based investment management firm founded in 1939 by Roy Neuberger and Robert Berman. In 2003, Lehman Brothers acquired Neuberger Berman alongside with several other asset management firms, including Lincoln Capital, Fixed Income Management, and the Crossroads Group. As most of us remember, Lehman Brothers collapsed and went bankrupt in 2008 during the global financial crisis. Lehman Brothers originally planned to sell off its asset management businesses, but Neuberger Berman's management counter-offered with a management buyout. As a result, Neuberger Berman integrated Lincoln Capital Fixed Income Management and the Crossroads Group, and spun itself off in 2009 with the new entity retaining the Neuberger Berman brand name. Neuberger Berman focused on maintaining as an independent and privately owned business, steering towards employee ownership. The firm achieved 100% employee ownership in 2014 and has been maintaining it since then. Today, Neuberger Berman is one of the rare asset management firms globally that is fully employee-owned and links compensations with the strategies and products it offers. This ownership model also promotes high retention rate, with the firm having over 95% senior investment professional retention rate over the recent years. As of end 2024, the firm is owned by about 800 employees who comprise about 28% of the total staff strength. Neuberger Berman manages $538 billion of AUM as of June 2025. Product offerings are quite well diversified, with about 26% in equity solutions, 39% in fixed income solutions, and the rest in various alternatives and private markets offerings. The firm primarily offers actively managed solutions, though there is intention to increase efforts in passive solutions in recent years. The Neuberger Berman US Equity Premium Fund that is covered in this video falls under the Hedge Funds and Liquid Alternatives category, which is a small but growing business segment. The Neuberger Berman US Equity Premium Fund is a sub-fund under the Neuberger Berman Investment Funds plc fund family. Neuberger Berman Investment Funds plc is set up as an Irish ICVC company structure and is UCITS qualified. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. I am quite surprised this is not a MAS restricted scheme, as this is not a typical equity fund, but instead is more like a hedge fund. The Neuberger Berman US Equity Premium Fund webpage indicates Derek Devens as the only fund manager for the fund, which is consistent with Morningstar information that he is the only manager since the inception of the fund in 2017. Derek is a senior portfolio manager of the option group in Neuberger Berman and looks to have experience in fixed income and alternative strategies. Exploring the US website gives us more details on the option group, whereby Derek appears to be the most senior in a team of 4, focusing on various options-related investment solutions. Index put-right strategy appears to be the core competency of the team, and it is actually also what the Neuberger Berman US Equity Premium Fund is all about. There is also a seek and avoid list that is kind of like the investment philosophy of the team that helps investors understand better on their general investment approach. The Neuberger Berman US Equity Premium Fund was actually previously called Neuberger Berman US Equity Index Put Right Fund and was renamed on 1st July 2024. The original name was definitely more accurate in stating the fund strategy, but probably sounded too technical or too complex to attract retail investors. The fund strategy is actually quite straightforward, which is essentially writing and selling put options on US equity indices and ETFs and collateralizing the rest of the portfolio via short-term US treasuries. As you can see, the fund strategy actually holds no equity exposure at all. This is why this fund is considered as a liquid alternative fund instead of an equity fund. So what really does put right options do? Selling a put right option on a stock means you are giving the buyer a choice to sell you a stock at a predefined price, and you are obligated to fulfill the agreement if the buyer exercises the option. In exchange for that choice, the buyer pays you a small option premium at the start. Using this example from Investopedia, the option has a strike price of $70 and the premium is $3. So as the writer of this option, you would want the stock price to stay at least above $67, which is your break-even point. So this works best for you in a flattish or positive market environment. Neuberger Berman takes a slightly different viewpoint comparing selling put-right options versus directly owning a stock, as it is running a fund portfolio. As illustrated in one of his articles, a flat market is obviously best as the fund earns the option premiums and doesn't have to take any other action. A strong positive market is actually bad for the fund, as the fund doesn't participate on the upside except for a little bit attributed by the option premium. A negative market is also not ideal, although the fund would lose less compared to holding the stock directly, as the option premium buffers some losses. The fund actually will have a slightly more upside as there is also an income stream from the collateral investment in short-term US treasuries. As such, Neuberger Berman believes the put-right option strategy can be a decent approach to gain long market exposure and generate income. It is also interesting to see in the same article that the team believes put-right option strategy is more efficient than covered call strategy, which is why they have not included the latter in the fund. Now that we have gone through a quick 101 on put-right options and understand the team's convictions in this option strategy, let's go through the fund strategy in proper. The investment objective is straightforward, which is to seek long-term growth of both capital and income generation. We will see later how the fund does in terms of actual performance and distributions. The investment approach is also pretty straightforward, as I mentioned earlier, which is essentially writing collateralized put options on US equity indices and ETFs to get indirect US equity exposure. Returns come in the form of option premiums as well as from the collateral portfolio, which should typically be invested in short-term US treasuries for minimal risk exposure, despite the prospectus states the fund can invest in other types of government-affiliated bonds or non-US sovereigns. The prospectus continues on with the collateral portfolio by stressing it would primarily be investment-grade bonds meant to provide liquidity and preserve capital. The prospectus also states there is a leeway for the fund to hold some direct stocks or equity ETFs, although this should not happen often. This follows with a pretty detailed explanation of put-right option strategy. Given this is what the fund primarily does, you should at least make sure you understand what this section is talking about before considering the fund. As the saying goes, never invest in something you don't understand. The prospectus then provides an elaborate coverage on the investment process, which is seldom seen available from most mutual funds. Here, it states various considerations when figuring out the appropriate put options to write in the portfolio, including factors like market volatility and risk, underlying instrument valuations, contract terms, exercise prices, and expiration dates. This follows by more elaboration on how the portfolio maintains diversification within the pool of options invested, such as writing options on different indices, laddering option expiration dates and rolling options at different timings, and spreading option strike price. There is also a mention that options may be closed out early for profits, So all this show that there is quite a lot of active management work being done behind the scenes. This is further emphasized in the risk management section that actually covers descriptions specific to the options handling in the portfolio rather than generic risk statements like most other funds do. Worth to note is that the fund will use cash-settled index options to avoid delivery of underlying index or security, but it is also stated the fund will liquidate any delivered positions if it happens. Given the fund writes and sells options, the cash in the portfolio serves as collateral. The permitted investments for collateral are broad, though the fund will primarily invest in high-grade liquid bonds and money market instruments. As mentioned earlier, the default choice would be short-term US Treasury bills, unless the team finds anything more attractive and with similar low risk. There is also an investment restrictions section that ensures risk is managed in the collateral portfolio, such as max 30% high-yield bonds, max 30% securitized assets, and max 10% in single high-yield sovereigns. The fund can hold 100% in cash if needed, which is okay for this fund because the whole portfolio is intended to be collateral anyways. It is also stated there is no lending or leverage in the fund. This follows by a pretty long section on benchmarks, whereby the fund actually has a benchmark and a reference benchmark, and both are meant for performance comparison purposes only. The benchmark is a 50-50 blend of two CBOE S&P 500 put right index, one that sells put options monthly and the other that sells put options weekly. This is probably to reflect the flexibility of the option terms in the fund portfolio. The reference benchmark is the S&P 500 index, which is used to reflect actual US equity market performance so that investors can compare how the fund performs against normal equity exposures. It is important to note that there is no objective stated for the fund to outperform either the benchmark or the reference benchmark. In any case, we will see later how the fund performs against these indices. I really like the information provided by this fund, as it is definitely one of the more detailed investment strategy and investment process provided in the prospectus. Let's move on to the actual portfolio details next. The Neuberger Berman US Equity Premium Fund was incepted in end 2016 and currently has slightly over $700 million of AUM. It has a daily valuation and trading frequency and comes with a T plus 3 days settlement period, which is the same as most mutual funds. The fund webpage doesn't contain portfolio information, so we will refer to the fund fact sheet for details. Since this is not an equity fund, the portfolio information provided is very different from the usual stuff you find in equity funds. The fact sheet shows 100% of the portfolio exposed to S&P 500 index, suggesting that all the put options in the portfolio currently are on S&P 500 index and not any other US equity indices. There are some risk measurements available, though I am not sure if they are in relation to the benchmark, which is the combination of the two CBOE put right indices, or the reference benchmark, which is the S&P 500 index. The statistics on the options show that the fund currently has only 20 options, and they have an average 18 days to expiration, suggesting that the fund rolls over the options pretty frequently. The options exposure and notional collateral matches nearly 100%. The statistics on the collaterals show that the fund currently has only 8 holdings that are all in US Treasury bills, and majority of them are less than 1 year and the rest less than 3 years, resulting in a weighted duration of just 0.67 years. Weighted average yield to maturity is 4.15%, so the collateral portfolio can generate a pretty decent yield to contribute to overall fund returns. Having a portfolio of just 8 US Treasury bills plus 20 put options on the S&P 500 index sounds very simplistic and easy to manage. But remember, these are all very short tenor positions, so you do need very active monitoring and systematic adjustments to the portfolio daily to roll over positions, find the most optimal options, and monitor for market anomalies to reduce volatility and risk impacts. Also not forgetting the flexibility of getting in and out of the fund easily on a daily basis. These things might be easy for a sophisticated or institutional investor to replicate, but it is quite difficult for retail investors. Therefore, these are what you pay the fund management fee for. As the Neuberger Berman US Equity Premium Fund is an alternative strategy, Neuberger Berman doesn't seem to be actively promoting this fund in the retail segment yet. There are only two retail A share classes created so far, and they are both offered in Singapore. The rest of the share classes are more for sophisticated and institutional investors, or catered for European investors. Both share classes were launched in 2017, shortly after the fund was incepted. The US dollar class is accumulation only, while the Sing dollar hedge class has a monthly distribution frequency. The A share class has a 1.2% management fee. Adding other expenses comes to a total expense ratio or TER of 1.28%. Up to 60% of the management fee can be paid by Neuberger Berman to distributors as trailer fees. The fund allows up to 5% subscription fee to be charged by distributors. Although I think anything more than 2% for mutual funds and liquid alternative funds are excessive. I couldn't find distribution information in the Neuberger Berman website, though it is available in Morningstar. Looking at the past distributions, they calculate to around 0.6% per month. So that means the Sing dollar share class is currently paying out about 7.2% per annum of distribution yield. This is actually quite high, so we will see later if the fund performance is enough to cover the distribution yield. Before we go through the performance of the Neuberger Berman US Equity Premium Fund, it is important to understand the differences in the performances of the benchmark and the reference benchmark, then figure out where the fund fits in. Derek and his team published a white paper in 2023 that contained an interesting chart for investors to think about. This is a returns versus volatility chart that maps out three equity market indices and their associated CBOE put-right indices. As this fund is focusing on US markets, we put our focus on the topmost pair and we can see clearly that the CBOE S&P 500 put-right index has lower volatility but also lower returns than the S&P 500 index in the long run. However, we need to remember the benchmark of the fund is a 50-50 mix of the 1 month and 1 week versions of the CBOE S&P 500 put-right index. Referring to the dynamic chart available in CBOE website, we can see there is actually a significant performance difference between the two indices. If we take a rough estimate, the 1 week put-right index should have around 4 to 5% per annum return in the long run. So I've added a data point in this chart to reflect that. Given the fund runs an active strategy, we would therefore expect it to do better than the CBOE S&P 500 put-right indices mix, but it would not be practical to expect it to do better than S&P 500 index. So the fund should hopefully end up somewhere in this box. This is the expectation that investors should have on this fund, as there is nothing outrageously different that the fund is trying to do to jump out of this box. So again, performance data is not available in the fund webpage but can be found in the fund fact sheet, which includes a cumulative chart versus benchmark and the cumulative and annualized returns across time periods versus benchmark. Looking at both the chart and performance table, we can see the US dollar class has quite comfortably outperformed the benchmark, which is the CBOE S&P 500 put-right indices mix, across all time periods. Even the Sing dollar hedge class with the currency hedging cost has managed to outperform the benchmark on 3 years and since inception basis. We can also see that the returns of the Sing dollar hedge class in recent years look to be able to sustain the 7.2% per annum distribution yield. There is, however, no comparison against S&P 500 index in the fact sheet, so we will have to use Morningstar to do that. Unfortunately, once we throw in S&P 500 using SPDR ETF as a proxy, it immediately shows a big performance gap versus the fund. Morningstar also happens to have the CBOE S&P 500 put-right index, but not the 1 week version, so I've also added that in. We can clearly see that the fund is actually struggling to outperform the CBOE index, especially in recent years. Moving the time period nearer to past 5 years, we can see the underperformance of the fund more clearly. This brings about an important question of what is really the benefit of having this fund in a portfolio. In the charts, we can see that there is a decently high correlation between the fund and S&P 500, but the overall returns are less than half of S&P 500. So an investor can have $50 in S&P 500 and $50 in cash and still get better returns than $100 in the fund. There are also other existing products available that are more aligned to the CBOE S&P 500 Put Right Index, such as the Wisdom Tree Equity Premium Income ETF that I have added into this chart. So the performance of the Neuberger Berman US Equity Premium Fund, unfortunately, is a key detractor for investors' consideration. I think there are 2 points for investors to understand here. The first, referring back to the white paper chart, is that running a put-right strategy on US equity market doesn't really give much risk-reward benefits. There is obviously lower volatility, but the returns are also lower. The only market that looks beneficial to do this is the emerging markets, whereby the put-right index actually has lower volatility but higher returns. The second point is that while we expected the fund to have a performance somewhere in between the CBOE Put Right Index and S&P 500 Index, the reality is that the fund unfortunately has been at the low returns end that is similar and even underperforming the CBOE Put Right Index. While we can partly blame it on the high management fees for the retail share class, or that the fund strategy has opted to go for shorter option expirations to reduce risk, the reality is that the fund is simply not generating a high enough return to be attractive to investors. Can investors use this fund tactically to reduce drawdowns in a bad market? Sure, because of the lower volatility, the fund obviously will have lesser correction in a bad market such as the year 2022. However, this requires investors to have a very good market timing capability. Firstly, to switch into the fund before the market corrects, and then to switch back to normal S&P 500 exposure when market recovers. Missing out on the market timing has a very high chance to miss the recovery upside. For investors that are not confident with their market timing skills, or for those that do not monitor the markets so actively, it may be better to leave the S&P 500 exposure untouched and ride through the volatility. With that, let's summarize our findings. Neuberger Berman is a US-based asset management firm with a long heritage and a diversified product range. I particularly like the 100% employee ownership structure, as I think it ties fund manager and investor interests together closely. The fund is managed by Derek, who is the most senior member in a small team of 4 dedicated to alternative strategies focusing on options. The investment strategy and investment process provided are clear despite this being an alternative product. This is a pretty straightforward fund provided you understand the concept of put-right options. The main problem with the fund is the relatively low performance, as it is possible to find other products with similar strategies and with better returns. The low performance leads to the question of positioning of the fund in a portfolio. It is not attractive enough to be used as a defensive way to get US equity exposure, and it is difficult to be used as a tactical switch from typical US equity exposure during market corrections. In conclusion, I think the concept of put-right option strategy packaged in a fund is a good idea, but unfortunately the performance outcome is really quite lacking. This concludes my absolutely biased comments on the Neuberger Berman US Equity Premium Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.